Good evening, everyone. Thank you for dialing into this month's webcast on the economy, markets, and investments, the April edition of the E.M.I. So let me cover them in that order: the economy, the markets, and the investments. So I'm going to be focusing today on both the short-term economic outlook and the medium-term economic outlook. But on the markets, I'm going to focus only on the long term because, as you know, in the short term, we have the elections coming up. Market has discounted a lot. So being very close to the elections, I think at this point, short-term view is a little bit hazardous to guess. So I would rather focus on the medium-term outlook for markets and consequently on the investment side also. So let me start with the economy and looking at the short-term outlook of the economy. This gives you in a snapshot multiple high-frequency indicators, how they have moved since COVID. As you can see, the first wave of COVID, second wave of COVID saw a drop. And since then, something unfairly extended V-shaped recovery on a laterally up move is seen by and large in most indices. Some of these we'll cover in detail, but also more critically to look at the last 6-8 months from September onwards to March. You can see that most of these indicators have been either green or yellow. Yellow means roughly similar to last month. Green means better than last month. So except for tractor sales in February and fertilizer sales in February, which are in the pink red territory, which is worse than the previous month, by and large, all indicators have been indicating a stable or a growing situation in terms of their indicators. Right, and as I said, specifically, EV bills are of importance because government expenditure is done through EV bills. So I think this indicates that the government is actively in the economy, buying and selling goods. So at the same time, rail freight, which is a good indicator of the goods movement in the country, also shows a positive uptrend. And housing, which is a multiplier effect because multiple industries get benefit from housing growth. You've seen that residential sales have touched a new high, though new launches by developer have seen some moderation. But both sales of already built units plus second-hand sales both have touched new high. And because of this demand for houses, you're seeing that house prices continue to visit double-digit growth. So clearly, people have enough money to go and buy houses. So sales on houses, which is again a good indicator for the economy. On the back of housing loans and personal loans and a little bit of corporate credit, you're seeing that credit growth continues to hold up at the elevated levels of somewhere around 17% per annum. So that's again a good indicator of the coming growth story. Right. And the one way to look at the GDP is to look at the breakup. So GDP is essentially private expenditure, which is private consumption, plus government consumption, which is government expenditure, plus fixed capital formation, both from government and private, plus exports. This gives the summation of the GDP. And as you can see, by and large, except that government expenditure they've slowed down their revenue expenditure, but the fixed capital formation growing indicates that the government is also spending more on capex and less on revenue expenditure, right? So the augury of things to come in the next few months looks good from a index of consumer sentiment that's risen now back to the near the COVID peak, indicates that customers are over the next few months going to be going and buying things. That's what they're indicating in an opinion poll. Right. And from a housing perspective, today affordability, right? Property price divided by annual income is at the highest over the last 25 years, right? And if you look at it from the ratio of credit, right? Number of upgrades to downgrades, though it's moderated from the immediate post-COVID when we saw a sharp rise in the upgrades after the COVID, that's moderated now, but still you always have 1.8 companies getting upgraded to only one getting downgraded. So overall, an improvement story on the economy is seen in the fact that NPAs of banks and NBFCs continue to see a decline and a deceleration, right? So overall, to predict the next few quarters of GDP, the PMI indicators are very good predictors, and you can see both the services PMI and the manufacturing are close to their decadal highs and are trending upwards by steadily remaining above the 50 mark. Again, the same data, if you put among PMI other activity trackers together, it indicates that there is a robust GDP growth we can expect in the coming months also, right? So from that point of view, let's look at also the fiscal health of the economy, because growth can be achieved, but by more borrowing means it's not great, right? So now when you see the situation, you can see that the central government has consistently post-COVID been committed to bringing down the fiscal deficit. And for next year, they're promising a 4.5. So clearly, from an external rating agency, FII, FDI perspective, the government is managing its finances well. This comes from two parts. What is the composition of income of the government? Income or receipts, as for the government, they use mercantile accounting, right? So if you see there, that is the revenue expenditure which has been coming down, and the capital, sorry, not the expenditure, my apologies for that. If you see that the government taxes have been going up, right? And the disinvestment has been kept at a very low level, because that's like selling the family jewels. And if you see dividends and profits and debt has been coming down from a 52% high in 2021, we are now down to only 35% in debt, whereas your center's taxes from the same period from 41% of the total have gone up to 50% of the total. So where taxes are a more sustainable way, that as long as GDP grows, the tax component will grow. So this is a flow of income which you can say for the next few years is on a rising trend, which is good news from a fiscal deficit. At the same time, expenditure. Where are the government spending the money? The blue line tells you the revenue expenditure. The red box tells you the capital expenditure. Can you see that 2021 capex was only 2.1% of GDP? It's gone up to 3.4, whereas revenue expenditure has come down from 15.5% to 11.2. So both the quality of the receipts of the government, the quality of the expenditure are very good. So that's again something which keeps India's rating agency on a stable mode, right? And this focus on capex is not just to satisfy the rating agencies. The rating agencies give a high weightage to capex is because capex has a multiplier effect. So if more you spend on capex, the more the impact on the GDP, the more the tax revenue of the government will go up, the more the fiscal deficit is likely to come down. So overall, rating agencies also look at the quality of the expenditure that the government is promising and living up to, right? And naturally, from a government's borrowing cost perspective, this bond inclusion in the index, which happened last year, but will come into effect from June of this year, will mean that the government get access to an increased pool of capital from outside India, where the key is, of course, is that they'll be able to borrow at 3%, 4% rates compared to 7%, but they have to manage the currency depreciation. And if they manage that well, they've got a nice low interest cost of funding their expenditure program. And that's where, if you see, India's forex reserve, which are almost at $650 billion, is one of our biggest strengths in controlling the currency. And you can see that today we have an import cover of almost 11 months. Right. So again, something which is very good from India's perspective, that we have no foreign exchange crisis. In fact, if you manage to retain it stably, this bond, FII bond inflows can be a low cost of borrowing for the government. Right. So one of the important things to bear in mind as we are in election, and so it will not be out of place to talk about it, is that the single party leadership government is what has led to all of this growth, reforms, and the continuity of the policy, if this government comes back to the power, can be reinsured. So from a short-term perspective, those election results are key, because as you can see in subsequent slides, since the single party government came to power, there's been a significant increase in a lot of items. So now when you look at the medium-term outlook, right, one of the key things here, which I've spoken multiple times, is a shift in the center of gravity of the world from China towards India, right? This is because we've just hit their population. But the way China has capitalized on the population to grow exports, we are a long way to go. So if you can see here, India and China almost share the same percentage of working age population, but India's export share is 2%, China is 13%. So India clearly, for a growth path, having got the population, has to catch up on exports, right? So from there, if you see, the availability of labor is a huge advantage to India, because from now to 2045, which is when we want to get into a developed country status, India is going to add 15 crore people, 15.2 million people to the workforce with age between 30 to 60, but China is going to lose 12 crore people. So clearly there's a shift of the balance of power on labor to India from an availability perspective. The second point here is the comparative labor cost. Now, when you look at it, manufacturing labor cost in the US is $30 per hour, China is $4 per hour, and we are $1.6 per hour. So we are 60% cheaper than China on manufacturing labor. So clearly, if we want to look at the growth aspect of it, it is manufactured exports that we have to focus on. Now, the key thing with the manufactured exports is that to achieve the quality of the products needed for the developed markets, you cannot expect Indian entrepreneurs, Indian manufacturers to overnight be able to satisfy those. So the way to go for India, the second is we are also starved of capital. In order to set up new factories, we need money. We have a limited amount of capital because we are not that rich a country. So this MNCs, if they are invited to set up in India, take advantage of our labor cost or labor supply, and if they can come to India, right, they are their sentiment score is now today in favor of India. So India minus China is actually in a positive. So from that point of view, then we have to make it clear that MNCs have to come. What is the benefit of this? First, we get the capital from them through FDI. Second is they will train our labor over a period of time so that like China went through the journey, over a period of time, we will be able to produce the quality products that the Western world can buy from us. So that's the reason the government has been consistently focusing on infrastructure because MNCs need multiple benefits. Already the sentiment in favor of India, but they need good infrastructure because when they manufacture the product to the raw material, close to the raw material, they'll want to ship the finished goods to the port as fast as possible. So general infrastructure is a very key necessity for them. And there, if you see, this government right from 2014, 15 to 23, compared to the previous decade, if you see, has been a sharp uptick in highways and broadband subscribers and renewable energy and in railway route electrifications, right? And so over this period, central government's capex has tripled. So you can see the strong commitment to capex, all with the idea of making it easier for those MNCs to come. And as I said again, this capex will again persist for almost 16 quarters, right? And another reason for focus on infrastructure is because elasticity of the job market is highest in the construction and utilities. So more jobs at the lower end of scale can get created if India boosts through PLI as one example and government spending on infrastructure to boost the employment generation, which is very key because I told you about 15 crore people are coming into the workforce. If you don't provide jobs, you could have a very different problem on our hands, right? So that's why the government has launched this PLI scheme to boost export-oriented foreign investment, right? So where are they given? They announced all of these spaces where they said that we will give a 5% incentive to them. So you can see that is a production of a range of things. And where is the incremental capex going to be generated by these FDI? It's probably going to be in chemistry cells, battery storage, auto and drone, and specialty steels. Whereas India has also made it convenient for the FDI person by reducing the tax rates on new manufacturing companies to just 15%. So under the PLI, you get a 5% cashback plus 15% lower tax rate compared to a broader 25%. So I think that this is making it attractive to MNCs to come in. They still have to see a growth in their country. They still have to do a lot of shifting to make India. But already, if you look at it from a financial attractiveness, people skills and availability, and the environment for business, cost of doing business, you can see that India is already inching ahead of the other competitive countries. And the success has been seen where there's the least amount of infrastructure required because electronic exports can be sent by airways and not necessarily by ships or by road. So you can see that it's a sharp. So PLI has been a big positive in the electronics business, right? And if you now see, right, from the year 2017, when we had less than 1% global shipment share of iPhones, today we have 10% share of the global shipment of iPhones, right? So there are a number of other success stories who have invested in India under the MNCs, under our future potential. This is one list. This is the second list, right? And then there's a third list of MNCs expected to come to India over the next few months and years. And this again is a two-page kind of a list. So clearly, PLI-driven, foreign MNC-driven manufacturing is set to take off. So government infrastructure has already taken off. Foreign manufacturing is also set to take off in the coming months, right? And hence, this gross FDI flows have more than doubled in the last decade for India, partly due to the PLI scheme, right? So, and where has this FDI come? It has come mostly in the construction infrastructure and the computer software and hardware, which you already saw in terms of the volumes, right? So, and those sectors where the PLI investment is coming are also seeing a credit growth because they can put in X amount of capital, but they need to borrow from the bank to complete the project. So banking is also seeing a strong rise, as you would have missed earlier, of credit growth, right? So now those two angles of the capex are taken care of. What about domestic private sector manufacturing? Here, the problem is that after dropping to 60% levels during COVID, domestic private sector capacity utilization has got stuck around 75%. So unless this goes to 80 and looks to go beyond it, you are not like to see private sector come in strongly with capex because existing capacity is still 25% unutilized, right? And so if you see projects under implementation have seen a dip, new projects, investment projects announced have also been seen a dip, and states, however, have been spending more on capex. Center has been spending more. So it's the private sector which is not yet coming and expanding capacity aggressively, right? But it's not that they have forgotten it. They're all speaking of capex in their calls and their updates, but they would like to see more ground level demand pickup happen before they commit to a factory, which will take 2 to 3 years and cost a substantial amount of money. But this journey, I believe, is just going to begin. And we are at the early stage of the capex cycle where from 9% of the GDP, 27% of GDP is slated to go to 36% in the next 3 to 4 years, right? So this means that India's manufacturing can easily triple by 2030, perhaps even go 4 times if everything falls into place in terms of land reforms, labor reforms, etc. Right? And hence, a share of manufacturing in our gross value added is set to grow from 15% currently to 20%. Right? And when this pickup, you see the previous 2000 to 2010 was the previous capex cycle pickup. And then you had a long extended fall because that capacity created, thanks to COVID in the middle, took a long time to get absorbed. And now the new capex cycle has just started. So given the length of the previous capex cycle of at least almost a decade, you can expect this also to last for a fairly long period of time, right? So the same graph, a little bit of pictorially here. And now we come to the story of consumption. Manufacturing we saw. Now what is it? That capex recovery automatically leads to consumption recovery because greater jobs, more salary income means that people go and buy the things they aspire for. So consumption momentum also in the past has increased post the capex recovery. Similarly, this year also we expect that. And the beauty here is that India's per capita income is slated to double by 2030 from 2,200 to 4,700. The previous time this had doubled, I will show you the data a bit later. Previous time this had doubled, the bank deposit are also gone up, but that's a separate chapter we'll come to. But one of the things that's happening in the course of the doubling is the polarization of the rich and the poor. So today, if you see top 10% of India's population of 140 crores, that's 14 crore people, account for 75% of the nation's wealth. Obviously, these people cannot eat, drink, make merry for more than a certain amount. They will go and buy some high value items, high gold. So I think that's where the key here is that discretionary consumption is going to get a big boost when this number again gets doubled over the next decade. And the potential is huge. Only 50% of Indian households own a two-wheeler. Only 8% of households own a car. Only 40% of households own a refrigerator. Only 20% of households own air conditioners or coolers. So consumption itself spawns multiple investable themes, right? From rich premiumization to spending more on leisure, to the middle class doing lifestyle changes, to education abroad for their children, to buying their first house, to discretionary consumption from durables. At the same time, the formalization and the digitization of the economy has led to a lot of urbanization in terms of e-commerce, sanitation, health, energy, which has helped the economy. And at the same time, the rural filter has also helped in terms of growing this. So there are multiple investable themes under the India's consumption basket, right? So from a growth rate perspective, over the next 5 years, you're going to see the retail market triple to $2 trillion and the e-commerce opportunity to go 4 times to $400 billion in that period. So rest assured on the consumption story. Now there's a third segment here, which is called the services segment. And so the biggest thing that has recently happened is digital transformation, right? So many things have shifted completely to digital. In fact, our success story in smartphones is clear to see. We have the lowest data pricing in the world, but we have a penetration of almost 66% of people owning at least one smartphone, right? Clearly, cheap data has worked its way, and the digitization, Jandan, JAM, they call it, Jandan Ajar and Yojana, right? Yeah. So there, Jandan Ajar Mobile, there if you see, we have made a rapid progress because what normally should have taken 47 years, we have completed that in 9 years in terms of account openings, right? And the whole digital story comes through in the UPI payments. Right? Pre-COVID to now, there's a 10x growth in the UPI payments. So clearly, digitalization and all are working very well. And hence, from an export perspective, non-software exports has gone up from 5% to 10% of the world, right? So that's the good news I wanted to share. And naturally, this kind of digitization is leading to a lot of people looking at starting their own companies. So we have almost in the last 6 years, 90,000 companies have set up startups. And the beauty is that of the 90,000, 100 have achieved unicorn status, which is more than $1 billion market cap. So clearly, they have invested in early stage income. And these, out of these 100 only, you will see listings in the stock market over the coming years, right? And where does this FDI flow come in? Is mostly come in, if you see from a percentage point of view, into manufacturing, a little bit into IT BPO services, and a little bit infrastructure. But where I've shown the yellow are ones where the maximum changes occur. So if you see in pharmaceuticals, it's only 0.9 to 4%, right? In IT BPO, it's from 14.5 to 18%. And in the case of energy, from 3.6 to 6% almost. So these are the areas where FIIs are putting in their money. Within the services bracket, there's also financial services. Here, if you see, the scope is tremendous because mortgage as a percentage of GDP is only 11%. And total credit to households of GDP is also hovering at around the 58% mark, whereas advanced countries are way, way above us, right? So to summarize it, India is at the early stage from just out of the bottom and stuck in the middle of the upcycle, right? We're seeing the development across multiple frontiers, but it'll take some time for the education to come up the standards and straight away take up those China-related jobs, right? So what this means, since I compared with China, is that we think that what China achieved in just 4 years, we will take 9 years anyway to achieve. But in 9 years' time, I think our per capita GDP would have doubled and our nominal GDP would have gone to 7 trillion. And this then sets the case for the next 10 years in terms of getting a greater export market share out of China, right? So in 4 years, India is all set to peg India's growth at the third largest economy in the world, overtaking Japan and Germany, right? So from that point of view, I believe that India or Bharat can grow conservatively at 11%. How? 6.5 to 7.5% real GDP growth and inflation around 4 to 6 would give us a 11% growth of nominal GDP. But I believe that Bharat can grow at 1% more, at 14% per annum, and 13% overall. Why is that? Because of the fact that we expect a tripling of the manufacturing services and private sector in basket to reach that $10 trillion mark, right? So from a market's perspective, there's an enormous opportunity. And where it comes from is the fact that India's market free float is only 58%. 42 owned by promoters take away. Now, when you look at the table on the right side, which is the free float graph, you're saying FIs still own the stock of 32%, whereas domestic mutual funds are owning 15%. These two big accounting for 50%. But the long-term average, if you see, earlier FIIs were more than mutual funds. Today, mutual funds are greater than FIIs, right? So now when we come to the medium-term outlook, which for capital flows, we talked about the economy. Now we talk about the market. The focus on capital flows medium term comes from the fact from on FIIs, and then second is domestic. On FIIs, if you see, what I consider as long-term capital, right, is the one on the left, which is the red and the green, which is pension funds and sovereign wealth funds. They were both put together 24%. If you see here, sovereign wealth funds alone for the last 5 years have grown from 12 to 16. Why is that? Because their allocation is linked to a country's share of the global GDP. So here, if you see, by the end of the decade, India is expected to contribute 1/5 of global GDP, besides which India's contribution on a relative basis is set to rise from 3% to 7.7%. So drawing our attention to the fact that allocation of distributed pension funds is the country is often linked to its share of global GDP. This augurs well for getting money there. Plus, in addition to long-term money, there's also mutual funds which are passive mutual fund where customers put money, they have to buy the index. So this emerging market index contains a share for India. And there, if you see now, that share has gone up to 16% almost. So clearly, right, from that point of view, in that area, there's no water shortage. And hence, they are going to take the advantage of the fact that the monsoon, northeast monsoon might be stable, whereas it's the western monsoon, which is so far not proved right. So to summarize this, right, soon for an international investor, there will be a TINA factor to put money into India because at 6.2% growth rate over the next, whatever, half a dozen years, we are going to look like in the money, right? And bear in mind that a foreigner looks at a rating and all of that. Why? Because his risk of his capital getting eroded. So from a downside risk to real GDP growth, if something happens, India is the most resistant or the second least you know, chances of a downgrade of our GDP, whereas other countries have much higher probabilities, right? So from a safety perspective also, India makes a very good case, right? The other thing which helps FIIs is the longer term nature of both the FII money and the domestic money, touching 35 months and 45 months, to prevent the volatility related churn, right? So I think the increase in the SIP book here and the increase in the sovereign wealth funds from 12% to 60% have played a significant role in making sure that our average holding period goes up and hence the volatility comes down. Similarly, on the volatility index itself, you see over a historic period of time, India has always been at a lower value compared to the uh, world market volatility. Okay. So from that point of view, right, if you then look at it from a beta perspective, which gives you a sense of the relative risk, right, you can see that 1 year rolling beta of in MSCI India is coming down. So beta gives you the relative riskiness of India. So India is moving more on lines of a defensive stock. As you're aware, defensive stocks like FMCG, pharma, IT tend to get higher valuations than a cyclical growth stock. And that's exactly what's happened is that Indian market is trading at a premium both to emerging market of 90% and about 38% to that of the world market. So this premium gets justified among various factors among India's growth rate being the highest in the world and the fact that the market churn is relatively lower than the rest of the world. So you can expect in the medium term, as long as India's growth story continues, for this to sustain, right? Now, it's not just foreign flows which are going to drive. Domestic capital flows are also going to help the valuations and the growth of the capital markets. So there, when you look at it, we talked about the doubling of our per capita GDP from over the last 10 years, and the next 10 years we're expecting to double. The previous 10 years when it doubled, we saw bank deposits grew 3x, right, from a 64 to 170. So this time again, you can expect a 3x savings growth, but may not all go to bank deposits. A lot of it will come to the capital markets. So here again, the polarization of the income means that at the higher end, people have more money, not only to spend on discretionary, but also to save, right? So from that point of view, we have a long way to go. Percentage of household assets and equities is just 4.7%. This 4.7 compares with 22% in the US and 18% in Japan. So equities as an asset class across direct equities, mutual funds, as well as portfolio management schemes are all come put together only 4.7%. And within this basket, if you see that mutual funds are only 2% of the total. So there is a scope for mutual funds to grow is enormous. And the total number of mutual fund investors in the population is only 3.5 crore on a 140 crore population. So there is scope for increasing the penetration of the wallet of existing customers as well as adding new customers to the industry, which if you look at it from the mutual fund assets under management to GDP, India is only at 17%, whereas Singapore, USA, UK are all in the 70s to even greater than 100%. So the runway is very clear for equities and mutual funds to increase in terms of the allocation, and hence stock market prices and valuations and wealth management will get a big boost, right? And what's a sustainable story is the fact that significant proportion of money post-COVID has come from SIPs. From just an 8,000 crore SIP book in Feb 2019, we are now at almost 20,000 crores, right? So this gives monthly money to buy. So the markets are unlikely to see a huge correction anytime because of the fact that any correction, there will be money in fund managers' hands to go and buy good quality stock, right? And so if you see, mutual funds have been winning the battle versus bank deposits. In 2010, mutual fund assets were just 13.7% of bank deposit. Today, they are 27% of bank deposits, right? So now we move from this to flows to the markets. And as we said, we believe that Bharat can grow at 11% for the rest of this decade and 14% from the next decade, right? Averaging 13% for the next 16 years. But if you see that the stock market, because the formalization economy will mean an expansion of the listed universe, you can expect the stock market to beat the nominal GDP growth by at least 1%, very conservatively. So what was 11 and this becomes 12 and 15, averaging now 14%. And the past proves that this happens. If you can see here, the stock market goes up and down, but over a long period of time, the white line of nominal GDP, the stock market grows faster than it. So the numbers that we expected to grow, I think, are eminently possible, especially because India in the cycle is just come out of the COVID cycle and is stuck somewhere in the up cycle. As I mentioned earlier, domestic private sector capacity expansion hasn't yet started. It's only the PLI, FDI through PLI, as well as the government infrastructure that has brought it to this level. So next phase of expansion, followed by a late cycle, are all stories yet to happen in the coming years. So naturally, when you look at it from a capex cycle, when the previous time our capex cycle grew, Indian markets outperformed developed markets. Then when the capacity is less, we have not broadly outperformed. But now the new journey, which is a replication of the old capital formation, again, we have started outperforming the world market. So from an FII perspective, they will feel there is the right time to allocate money to India, and hence the market can grow, right? Now, the mutual fund universe itself, right, has investment potential to expand because, like I mentioned, penetrating into customer wallet, expanding of the customer base, and fund managers delivering better returns than the product market. So if you add another 2% alpha from this, you can see that we would be able to average 16% annum for the next 16 years. So basically 2024 to 40, we can call it as the power of 16 by 16. So from that kind of a situation of the market and the overall mutual fund industry, you can see that investments, right? The peak point is that assessing customer risk appetite is very key. Why? Because there are customers. The reason one of our penetration is low is we've been only selling the high risk equity to customers. Whereas customers who put money in bank deposits are all of more conservative nature or of a moderate nature. And if you see the moderate nature funds like balance advantage, equity savings, they all delivered on a pre-tax basis itself better than bank deposits. But if you take the tax benefit, they can easily see they're doubling the return, post-tax return to a high tax investor, plus the fact that you get the inflation beating returns also. So both inflation and FD returns can easily be beat just by the hybrid. So I think the industry can expand tremendously just by pitching the right products based on the risk profile of the customer, and hence a more tuned to the customer growth. These could be the first point of entry for new customers. As you saw, only 3.5 crore customers have invested compared to 140 crore of our population. So hybrid products are a good way to ease them into the capital markets. Further to that, this recently the multi-asset funds are an excellent addition to expand the MFD wallet share. Why? Especially through the power of gold. Those multi-asset funds which have significant allocation to gold, because a typical Indian family has a large exposure to gold. Thanks to that, they expect the future, the children's marriage, they need gold. Plus, historically, they viewed it as a very comforting thing. Now, the paper gold, which through gold ETFs and gold savings funds has been available, but the last tax bracket made the pure gold funds as unattractive from a income tax angle. So, multi-asset funds with some gold will also not only help people to increase the allocation because the gold can be bought through this, but also that along with it comes the equity, which will give a buying support to equities. So here, the other reason for gold is not just that there's an emotional connect to gold, but on a practical basis, if you look at the time since October 2005, 18 years time, and the 1 year rolling returns, if you take the gold during that period and compare it with the Nifty, you can see that 20%, almost 19 to 20% of the time on a 1 year basis, Nifty was negative, but gold was positive. So clearly gold comes in and protects you against equity's negative return. At the same time, when equity was positive, the balance 80% of the time also, 36% of the time, gold beat the Nifty, as well as 38% of the time, both gold and Nifty were positive. Only 26% of the time was gold negative. So overall, gold also delivers to you very contra returns. So a customer who's seeing some kind of erosion in equity, if he has gold in his portfolio, would be a much happier customer. Hence, multi-asset funds also should be used as a good customer acquisition tool. And for customers also, it's a wonderful product to add, because when you put these two tables together, you can see that almost half the time gold has beaten the Nifty. So buying gold in a paper format through this process is a very, very good diversification for the customer and helps to expand the customer base. The other solid reason for gold to be present is because in an economic cycle, right, there are always times when equity does well, times when debt does well, times when gold does well. So to hold a gold related asset class with yourself means that in those times you will be able to enjoy the benefit from it, right? And the last 13 years, if you see, half of the calendar year returns, gold has been the best performing asset class. Further, gold also gives you protection against currency depreciation. If you see here the last 5 year periods, the dark blue tells you how much currency depreciation helped the gold prices in India compared to overseas by and large. So then over a long period of time, there are periods, for example, in 3 year periods, sometimes rupee has depreciated by 7 to 9%. In 5 year periods, sometimes by 5 to 7%. Overall, over a 23-year period, there's been almost 3%. So that's the kind of India's additional return that you will get. So rupee devaluation, right? That's something that gold helps you to benefit from, right? The second aspect on an investment perspective is that asset allocation is key. Why do we say that? Because if you see, the returns over the calendar years of Nifty 50, Nifty 500, large and mid cap, small cap, they vary widely across the years. You can see the number of colors there. Red means it was the worst performing, pink less worse, green is the red. So the leadership keeps changing. So asset allocation is also a key element to improve your returns, right? And the problem for the industry is that you're very concentrated mutual fund industry, right? So the fund managers, if you see, just 33 stocks account for 60% of all active MF investments in India. And if you see the oligopoly of the market in India, just top 10 stocks account for 34% of the market cap. So this concentration is a very huge thing. So if you simply rely on the funds as it is, you will end up having only the larger portion, a concentrated portfolio. Whereas even if the fund managers, you look at the various types of funds and look at the large cap component, right? Focus funds have 60% large cap. Large cap funds obviously have 85%. Flexi cap have 65% on average. Large and mid cap 48. Value funds have 62. So clearly large cap tilt is there in across the mutual fund portfolios except the pure mid cap and the small cap. So by timing your entry and exit as per the business cycle into large, mid, and small, you can enhance this and pick the small caps when they are going to do well, mid caps when they're going to do well, and hence compared to a broad overall weighted average fund management exposure, you can add extra returns to the portfolio. So as I mentioned, right now from a cycle perspective, we are in the early cycle, right? And if you look at the large cap itself, you can see the variability of the monthly returns is tremendous. In fact, over a 5 year period itself, you see, even large caps have been through minus 3.5% or plus 41 or plus 1. So huge variability in this 5 years. Why? Because of this business cycle. Our economy has been through 1, 2, 3, 4 cycles, and the fifth one is underway. And there, if you see now the good cycle and the bad cycle, I will tell you that in the good cycles, what happens is that small caps are the best performing asset class, followed by mid caps, followed by large caps. You can see in all the 3 good cycles that this has been the case. Whereas in a bad vicious cycle, as we call it, you see the small caps are the worst performing, then the mid caps, then the Sensex. So from that point of view, if you choose the timing based on where we are in the cycle, you can basically get a better return than just a broad diversified portfolio, right? And the right way to then decide when to put it is, one is to be aware of the broad business cycle. The second is to look at the relative valuations. So if you now you see here in April last year, Mid caps were at 8% discount to the large caps, and small caps at 3% discount. If you had invested then, just by November, you see both have indexes have moved to 14% premium. So when something is selling at a discount, that's the time you should allocate more. So smart asset allocation can be a huge alpha provider to the investor, right? So basically, this kind of an appropriate asset allocation has an immense potential to add alpha of at least 1% per annum. So I believe if you then add all of these, I believe equity assets can grow at 16% for the rate of this decade and 19% from the next diamond decade, averaging 18% per annum for the next 16 years. That means the rule of 72 means that the equity AUM can grow 16 times in 16 years. That's the power of 16 by 16, and it's a very good time to take advantage of that. Right? Thank you very, very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.